Whenever there is a correction in the market, there is usually this doubt in our mind whether this correction is going to translate into a deeper one, or this is a minor correction and the uptrend is likely to continue, right? I'm sure many would face this issue, and I think that a proprietary indicator, which is the Rohit Momentum Indicator, will help you solve this problem, and it may help you to time your entry and exits better. So for that, you will need to learn this technique, and I'm very happy to share this technique. Typically, we see two types of market. One is the sideways market and one is the trending market. The application of RMI on these types of market is slightly different. So let us first look at how to deal with the sideways market. So RMI moves in a cycle. What do I mean by cycle is that, say this is the zero line which I've drawn, and it goes up, it comes back towards the zero line, it goes up, it comes back towards the zero line, and that's how it's behaving. So let's see it in the Nifty PSE. You can see that this patch has been the time where we have seen ups and downs, and if you see the behavior of the RMI, you can see that once there is a bullish crossover, there is an up cycle that you see over here, and then when there is a correction, you see the down cycle. Then in the up move, you give a positive crossover, and then there is a bearish crossover that you see, and that's how you will see the RMI behaving. And each of this move, basically, somewhere at the second candle or so, you will get a bullish crossover, and then when the decline is happening, you will get an early sell crossover as well. So this will help you to basically navigate each ups and downs in the sideways market. But one thing to note is that in the sideways market, you will always see the averages breaking. So in this case, we usually use the 20-day simple average and the 40-day exponential average, right? And you would see that in the sideways market, the averages are getting broken. The moment the averages are starting to get respected in correction, that is the time we can identify that the stock or the index is starting its uptrend, or it is going to be trending, right? So like I said that in a trending market, there is a different technique to use the RMI, but the basis will remain the same, is that when it goes towards the zero line and when it gives a bullish crossover, that's where it would be an indication of a new leg of up move. But when you see that the RMI is giving a bearish crossover, okay, and the prices are still continuing to rise higher, that's the sign that the market is trending. So in between, there would be a loss of momentum due to which the RMI is coming down, okay. But once again, when the market picks up, RMI will give a bullish crossover, and the prices will rise higher. When you start seeing such cases, then you simply have to trail your reversal at the orange line, which is nothing but the 20-day simple average, and till the time the 20-day average holds, your reversal level is intact, and the moment it breaks, that's where the risk of the RMI completing the cycle kicks in, which means that there could be more downside that you can see, right? So let us see from this patch to this patch, okay, where in the correction, the averages started getting respected, okay, and that's where you were seeing a bullish crossover and then a bearish crossover, then again bullish and again bearish. But in such cases, you would see that in the correction, the 20-day average is not getting breached, okay. In this case, your simple mantra would be to trail the reversal level with the 20-day average and ride it as much as you can, okay. Now, if we see the recent example, the bullish crossover we had seen was somewhere in the middle of the November. In fact, the start of November month, which was somewhere over here, right? And over here, the up move was very clean. In fact, there was a small dip that you could see over here, but again, there was an up move. But like I told you, that if the RMI is giving a bearish crossover and the prices are trading well above the averages, then 20-day average becomes your reversal level, okay. And you can see that in this entire move, the 20-day average is getting respected. So in the past couple of days, we have seen a good panic in the market, especially in the PSUs. But whether this will turn out to be a minor correction like this, and it will head higher, or it is going to lead to a deeper correction, for that you'll have to observe the price action very closely. So like I mentioned, if the orange line, which is the 20-day average, breaks on the downside, then there will be a risk of a correction, which means that the RMI may go back towards the zero line. And then as an investor or trader, your main aim would be to be disciplined and not to preempt the up move, because when there will be a correction, obviously it will not be a straight line correction, right? There will be pullbacks in between, and till the time the RMI doesn't go back towards the zero line and gives a bullish crossover, you need to be on the sidelines, because it would be an indication that whatever pullbacks that you're seeing in between are just a minor counter trend rally, and again it is going to decline. Because what happens is that when we are bullish about something, right, and if we see even a minor up move, then we start feeling that FOMO. And that's where I think the RMI indicator will add a lot of value, and it will help you to be disciplined. So in short, RMI plus the averages, and in fact, even if you follow the Dow trend, okay, these three indicators, if you use, I think this can really help you to, time your entry and exits. And I know, this looks very simple to follow, and you might feel that कि इतना easy market में थोड़ी कुछ होता है. But I'm very sure that, if you observe how this indicator behaves along with the moving averages in the trending and non-trending market, I'm very sure, you will be able to navigate all the ups and downs, and you might get better with your entry and exits. And to come to the screen, all you have to do is that you have to type any stock or the index on the way up, that is in the Google search, say Infi. Okay, I type over here, I go to charts, and I go to Rohit setup. Okay, the moment I go over here, you will see 4 time frames, that is hourly, daily, weekly and monthly. And you can choose any of the time frame which matches your time horizon. So if you still don't have Strike, log in to web.strike.money, create an account. You will surely get a 7-day free trial.